Hi, John. Welcome.
Hey, Mark, great to be here.
Let's jump right in. Where do you think we are in the inflation cycle?
Well, we're a little more optimistic about inflation. When you look at the numbers in our portfolio, we see input costs really coming down to almost zero year on year. Goods are starting to almost deflate at this point. On the labor side, there's obviously more tightness there, but wages for us fell below 5% in our portfolio companies in the third quarter. And then on the shelter cost side, we've seen that come down quite a bit well below what the government's reporting. So we think you'll continue over time to see inflation come down. Obviously, energy prices in the short run have been a bit of a headwind, but we think the path of travel on inflation is down and that the Fed's having success in this fight.
Yeah, that was going to be my next question, whether or not you actually thought the Fed was doing a good job of this so far, this whole fight with inflation.
Yeah, well, there was obviously a lot of criticism of the Fed on the way in on their call on transitory. I don't think at this point they're getting enough credit on the other side, which is they've moved very quickly, taking rates up from essentially 0 to 5.5%. And that is beginning to work its way through the economy with a bit of a lag. And now you add to that the long end of the curve moving up, which adds additional tightening in the system. It now costs, 8% to get a mortgage, 8% to get a car loan. That will have the impact of slowing things down. So it's not only the short end of the curve, which they've put in place to slow things down, the long end has moved up. And that, I think, will contribute to a slowing. So I think it will help bring inflation down further, but it does have the impact of also slowing the economy.
I think the point you made about shelter is a good one that really doesn't get played up enough. The notion that shelter costs are really, a big chunk of what we're seeing in CPI, and absent that, you're looking at a much lower, inflation reading.
No question about it. I mean, inflation in shelter is, I think, 7+% in the data. And it represents a third of CPI and about 40% of core CPI. And the reality is low single digits growth. So that delta should drag down the overall CPI number as reality works its way into the numbers.
So, I mean, with that sort of context too, can and what we've talked about in terms of the Fed's job and inflation essentially, drifting lower, can we avoid recession? Especially when we think about some of the things you mentioned as well, yield curve inversion earlier as a signal of what's to come, but yet we do see some signs that inflation is getting is shrinking.
So I think the Fed is going to slow the economy. That's really their objective, right? They want the labor market to be less tight. They want to slow economic activity and drive prices down in that process. And the old line about you can't fight the Fed, I think that holds true. So the question you're asking is, will this lead to a very sharp decline in economic activity, or will it be more gradual? I would say this doesn't feel like 2008 or 9, where we had a lot of imbalances, which led to a pretty sharp decline in economic activity. Here it feels like we're going in on firmer footing, but it does mean that the unemployment rate will likely go up. And it does mean that you'll see less growth going forward. And when we look at our companies, interestingly, in our private equity portfolio in the third quarter, revenue growth was still pretty good, high single digits. But when we look at the sequential path, it's generally lower levels of growth. And when we look at their hiring plans, it's much more modest than it was 12 months ago. So I think it points to a slowdown. It's hard to say, back to your question, just how deep this slowdown will be.
I mean, I think that's super insightful. It's really hard to see how we end up in a recessionary environment, just given, some of the things you've talked about. I mean, which I think are totally, legitimate. Just the questions about the labor market has been so resilient. With 3.8 or so % unemployment. And I think if you look at the St. Louis reading of GDP, we're looking at, 5.1% in the third quarter. It sort of boggles, at least my mind, to think about how that unravels, even in a mild to moderate recession?
Well, I would say there are some tailwinds to your point, which are there was huge stimulus and excess savings built up during COVID, and very significant fiscal stimulus that showed up in those savings. But we're seeing it also, of course, in infrastructure and green energy with the IRA. And then what's happening in digital infrastructure with some of the data center building. So there are some tailwinds and some reshoring that's going on because of geopolitical issues and what companies experience. So although the Fed is slowing things down, the train had a lot of momentum. So I think they will slow this down. But I do think that momentum means that the level of deceleration will not be nearly as bad, as I said earlier, as what we experienced back in 08, 09.
So I asked you about this, I think, last year when we talked, but I think it may be even more relevant this time. What's the state of the global economy? And thinking about it in the context of we've got at least two wars underway, and the U.S. as well could be pulled into that, and those could also escalate. So how are you thinking about the global economy?
Well, again, what's been remarkable has been the resilience of not only the U.S. economy, but the global economy in the face of the conflict in Ukraine and the rise in energy prices and food prices that caused. Now we have the additional terrible conflict in Israel and that part of the world. I would say the picture around the world looks pretty similar to the U.S. in the sense that unemployment is low, economies have hung in there better than people would have expected. I think Europe is a bit softer than the United States and faces more challenges. Asia, ex-China, is a little earlier in its recovery coming out of COVID. India in particular has a lot of strength. Japan has done quite well. I think China faces some headwinds around the housing sector there, much less foreign direct investment, and generally, companies being more focused on diversifying supply chains. So I would say overall, globally, better than people would have expected. But we've seen the same issues where the European Central Bank, the Korean Central Bank, Canadian Central Bank are all raising rates. And I think that will have an effect everywhere to lead to some slowing as we move into 2024.
There's some undercurrent with the current environment around the globe, geopolitical conflicts and in other events, climate change, even some rumblings around dollar hegemony or the U.S. losing dollar dominance, and wondered what you thought about that, and if that's something not to be concerned about, in the midterm, the long term.
If you look at the dollar relative to other currencies, think about the dollar, it's almost a price. The dollar, despite all the calls for its demise, is at, I think, amongst the highest levels it's ever been relative to other currencies. It's had a very strong run now for 4 or 5 years. I think it's just a question of the relative strength and size of the U.S. economy and the liquidity of our capital markets that allows the dollar continue to hold its strength. I think there are questions over time as we run very large deficits. Could we face more challenges? But I would say for now, the dollar seems to still be in a pretty unique position when you look about it versus other currencies around the globe.
You think about that from a dollar, concept, but you also think about the deficits, and the dollar has been strong, but yet as you think about yields have been moving higher. Then there's some questions about is it the Fed, or is it a lack of demand and appetite from foreign buyers? Are they shifting elsewhere? I think that also sort of informs people's views of whether or not there's a shift afoot.
Well, I think as it relates to the yield curve and the sharp movement we've seen in the 10-year, I think it's a variety of factors. One is I think people have begun to believe the Fed that they're keeping rates higher for longer because the economy has not slowed as much as people would have expected. I do think there's a supply-demand technical element to this. There are some foreign countries not buying as much. U.S. banks, certainly given some of the mismatch issues they faced on longer duration bonds, are being more cautious in that regard. And we're just printing a lot more in terms of debt. We're running significant deficits. And the Fed, remember, is also in the process of quantitative tightening, which is it's selling essentially additional debt as it shrinks its balance sheet. So I think it's a combination of an expectation now of higher short rates for a longer period of time, and then some of these technical demand supply issues. But I do think at some point people will say, well, if we've got 5% 10-year yields and inflation starts to head below 3%, the real return starts to look attractive to investors. And I think there will be some upper bound at some point here.
Good point. So I don't like to talk about politics as we shift gears, but let's talk about the state of Congress and what that means for decision making in terms of what we're seeing out of Congress. Are you prepared for a shutdown November 17th? Should that come to pass?
You know, we tend to be long-term investors, and we're investing in great businesses and assets. We're generally holding them for long periods of time. And there tends to be, as you know, particularly over the last 10 or 15 years, much more conflict in Washington, D.C. They generally find a way to avert major problems. And my hope would be that that's what happens again, that there's some solution on the speaker side and there's a way to make the government function. I think it's important given the geopolitical issues, but that's not sort of my place to be. They'll figure out what they do in Washington. We tend to focus on some of these macro things we've been talking about, but also the longer term trends in some of these industries, which will drive value over time. And I think as investors, focusing on that, some of these big mega trends is more important than sometimes the news of the day. And that's why we tend to focus on that when we're deploying capital.
So let's talk a little bit about, earnings from Blackstone. You guys reported yesterday and missed consensus analyst earnings estimates and profit and revenue. And the stock, I think, had its worst day in more than a year. Does the street have it right? How are you processing
Well,
that?
It's very hard to comment on the stock and certainly its intraday movements. For us, what we're focused on is what's happening with the business. And obviously we were in a tougher third quarter where the 10-year moved a lot. Equity markets were down. What we look at is the resilience of our fee-related earnings, which were pretty much flat versus last year. Our management fees were up year on year for the 55th straight quarter, which says something, I think, pretty powerful. And then the most important thing, Mark, is that we're delivering for our customers. The way we built the firm over time is by delivering great returns. It's a bit like a restaurant that serves good food. The customers come back for more. They try other things. In the third quarter, we beat public market indices pretty much across the board. We had particular strength in things like life sciences, infrastructure, private credit, really strong results. And that's the true north for us. If we deliver for our customers, they'll allocate more capital, we'll grow. What happens in a quarter, realizations are down when you're in a volatile quarter. That's a short-term phenomena. We're really trying to build long-term shareholder value on the back of long-term performance for our customers.
Yeah, and I guess it's fair to note too that over the year to date, you guys are certainly beating benchmarks in terms of the S&P, which seems to be worth noting. Let's talk a little bit about BREIT as well, which was launched by Blackstone, I think, 2017. And I think the idea there was to give retail investors a chance to own a piece of apartment buildings and warehouses and other commercial assets. You guys faced some redemptions during the market downturn, and I just wanted to get a sense of what's the state of play now, because that was certainly in the news a year ago.
The key thing to us when it comes to BREIT, like all our products, is delivering performance. And when we set up this vehicle now almost 7 years ago, our objective was to outperform public markets over time, and we've done that handily, almost 4 times the rate of return, nearly 12% a year since inception. And we did that by picking the right sectors, investing in things like student housing and single family rentals, data centers, key areas. Logistics is a major theme for us there. We did it all in the Sun Belt of the United States for the most part. We put in place a long-term balance sheet with some very valuable hedges. And I would argue that BREIT in many ways is amongst our best work in terms of investing in a very differentiated way versus other real estate investors. As it relates to liquidity and redemptions, we set up the vehicle knowing we were buying private assets with caps on redemption so that we would not be a forced seller and damage performance. And so there was a lot of attention going back almost a year ago. We saw that surge of redemptions for a period of time. And now those redemptions have come down. I think they were down 30+% on the quarter, 60% since their height. And to us, the system's working. If you were an investor, we talked about this on the earnings call yesterday. If you were an investor who started redeeming, you have gotten substantially all of your capital within 6 months or less. And so it's a system that we believe is working as intended. And the key is we've delivered really strong performance for our investors. And that's why this private wealth channel, delivering for those customers, very important. We think BREIT has certainly done that.
So I just want to ask you what could be our final question here. What's the state of commercial real estate? Is the mall dead? My local mall certainly is close to it. How are you thinking about that space?
Well, I'd say commercial real estate has a couple of challenges. One is the office sector, which you and I think, have talked about in the past. And obviously, because of remote work and obsolescence, I think we'll face some meaningful headwinds for an extended period of time. That is a tiny piece of what we do, U.S. office buildings. Retail seems to have stabilized, but certainly share continues to move online. So it's a much slower growth asset class. I'd say the other issue for real estate is the increasing cost of capital, which we talked about, which affects all assets, including commercial real estate. But on the positive side, I think there are a couple things to note. Where you invest matters. So our focus on student housing, on data centers, logistics, those three areas represent a majority of the capital we've invested across our real estate platform. When you're in faster growth sectors, you have a better ability to absorb some of the headwinds for higher cost of capital. And then I would point out what's happening on the ground now is new construction's coming down pretty dramatically, anywhere from 30 to 70% in the third quarter across apartments and hotels and logistics. And that begins to lay the groundwork for the longer term recovery.
I was just also wondering about refinancing risk too, because you mentioned this, the notion that we're at a point where we get 7-8% rates now, and certainly a lot of these deals were struck at much lower levels. So just wondering how you're thinking about that, and how the industry is the industry prepared to deal with that sort of refi issue?
I think for us, it creates some opportunity. We have a real estate debt business that is very sizable. We also are sitting on $66 billion of dry powder in real estate, over $200 billion as a firm. And that should enable us to provide capital to buy assets at a time when there's a lot of uncertainty. And often you can do very attractive things at moments when concerns are the highest. Ironically, as investors, people feel great in 2000 or 2007 or 2021, and yet you're paying very high prices. When prices come down, sentiment is negative in real estate, potentially other sectors. That can create opportunity. And that's how we think about investing as a firm. So I guess the short answer is yes, higher cost of funding will create some opportunities, create some dislocation. But as a firm who's not a forced seller of assets, but also has a large amount of discretionary capital to deploy, it can be an attractive time to invest that capital. And we're certainly focused on that.
I think that's all about all the time we have for this today. And I really appreciate you taking time out, Jon. It's always a pleasure to connect with you.
Thank you, Mark. It was great to see you.